So Harsha Upadhyaya joins us, represents Kotak AMC. Harsha, good morning. Thank you for joining us. Everyone is blaming the current market rout on global concerns. So how real are the global concerns? And do you think the global concerns could jeopardize the market again and further in the short term?
Yes, clearly, at least in the immediate near term, we are going to see risk off, and that's clearly evident not only in India but across global markets and global asset classes. I think that situation will continue for some time. But we believe that India is probably better positioned today than in 2013 to withstand such a reaction. Once the dust settles, I think India, both from economic perspective as well as from stock market perspective, will do definitely better than many of the emerging markets in our view.
So what does one do when there is a global tsunami which is staring at you? You know, on paper we are the great story, commodity prices are down, rates will come down. So yes, on paper I can make a brilliant case why fundamentals for India will improve. But the problem is that in a receding tide, when everything is getting knocked out, we will also take a hit.
Sure. As you rightly said, I think in the immediate short term, we can't get insulated from any of the factors that's happening in the global markets. We will also decline along with all other global markets. Our view is that downside is not going to be very large. We have been holding this view for quite some time that the market is likely to be range bound during this calendar year. We continue to hold that view. I think at lower levels there is always a good opportunity to look at some of the stocks which may have fallen more than the fundamentals actually matter, and in those particular set of stocks or sectors there could be buying opportunity from a 2 to 3 year perspective. That's what we have been advising our investors, that maybe next few months would be the right time to actually make regular investments, so that financial year 17 and 18, which are likely to be better years than financial year 16, can be really focused upon.
Harsha, you know, we've seen some resilience when it comes to IT as well as pharmaceuticals of late. Do you sense that if at all there are gains in this kind of a market, those are the pockets which would stand to benefit, and perhaps investors should stay put within the IT and pharma pack?
These are two sectors which generally tend to be defensive when the markets are collapsing, and that's what is perhaps happening now. But there are business specific issues in both IT and pharma. So to that extent, we are not really going overweight on any of these two sectors. In contrast, we are actually getting out of some of the global commodities and metal companies. We are not present in that space at all, and also we are looking at some of the purely domestic plays, so that at least the demand and the raw material costs are not really affected, and they should be looking reasonably okay even if there is volatility in the global markets. So generally we have been avoiding all commodities which are global in nature, and instead of that looking at local commodity which is cement, which should also do reasonably well when the infrastructure pickup gathers momentum. On IT and pharma, we continue to have some position in the pack, but we are not looking to go overweight on that just because of rupee depreciation.
Harsha, in general, there is a valid criticism which is centered around earnings. With each passing quarter, there is more and more disbelief now that what is happening to the Indian economy. You know, earnings will recover, earnings will recover, earnings will recover. I mean, hearing this story from last 6 quarters, and it may continue for next 6 quarters as well. So are we undermining the earnings problem?
No, clearly if you look at consensus estimates, they are on the higher side. They are still at about 16% plus for financial year 16. In our opinion, that's unlikely to be met. If at all, I think in a very optimistic scenario will be somewhere around 10 to 12% earnings growth for the year. So I think clearly market analysts at least are not downgrading the numbers as of now. We believe that that's likely to happen over the next 1 or 2 quarters. But second half optically will look better than first half, simply because if you remember, last December and March were really bad quarters. So from that perspective, the kind of year-on-year growth that you are seeing in first and second quarters of this year may not get repeated in third and fourth, and third and fourth will be optically better in terms of year-on-year growth. But that doesn't mean that there is going to be a structural revival in earnings story. For that, a lot of other things will also have to come into place. But there will be a cyclical pickup that you will see from December quarter onwards.
Harsha, where are you on this entire debate of PSU banks and what these new plans which have been announced by the Finance Ministry last week, what they will do to fix the entire banking sector per se? Is there a ray of light? Is there a hope now for PSU banks?
Within all our portfolios, we are still tilted towards private banks and not so much on PSU banks. We have a couple of plays on PSU banks and we are staying put with them rather than increasing that holding. While what has come out in the last 1 week is definitely a good step in the right direction, but lot more needs to be done as we go forward. And we will watch this space. Just the valuation cannot be the real reason for buying these stocks. If that was the reason, then for the last 3-4 years, one should have been buying only public sector banks. Along with beaten down valuations, you also need to look at something which is going to fundamentally change the way that these banks are working today. While there have been some steps, some announcements as of now, we will watch this space closely and take a call going forward. At the moment, I think our portfolios will remain tilted towards private sector banks.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.